Asia is shaping the future of digital assets, but crypto activity in the East Asian region, which includes China, Hong Kong, Japan, South Korea, and Taiwan, is struggling to keep pace with the rest of the globe. According to the latest report by blockchain analytics firm Chainalysis, the region is home to only the fifth most active crypto market in the world. The series of crypto-linked bans in China are the possible reason for the declining activity. But Hong Kong's status as a special administrative region of China and its growth as a crypto hub is being read as a sign of China becoming more open to crypto initiatives. Hong Kong also received an estimated $64 billion in crypto between July 22 and June 2023, much of it because of the highly active over-the-counter or OTC markets. Meanwhile, crypto trading in Japan is mirroring global averages, with activity split between centralized exchanges and various decentralized finance protocols almost evenly. In a statement sent to Forkast, Cheng Yi-ong of Chainalysis said that while Eastern Asia is not near its dominant position of 2020, it is one of the few regions that has been trending up in terms of capturing global shares over the past 4 quarters. Now, as crypto adoption spreads across the world, bad actors are not too far behind. Forkast editor and Asia correspondent Will Fee takes a closer look at the issues hounding the industry and the role of data firms in addressing them.
Trust, the very foundation of a financial system, is the glue that holds together the world of money and makes sure the wheels keep turning. But the collapse of innumerable crypto firms and projects, from Terra Luna to Celsius, 3 Arrows to FTX, and the arrest of high-profile crypto founders like Sam Bankman-Fried, Su Zhu, and Alex Mashinsky, among others, has, for many, decimated trust in crypto. News of scams, hacks, and other assorted crypto scandals have become a mainstay of mainstream and blockchain-focused media. So what could build back the trust in crypto and blockchain systems? Information and data could be the answer. Blockchain transactions are traceable. Once on-chain, a transaction is recorded forever for all to see. Blockchain analytics firms like Nansen, Chainalysis, Glassnode, among many others, collect and analyze billions of on-chain datasets.
If you look at crypto, because you can analyze the blockchain and you can build out an entity graph, as we have done, with very high resolution, you can get an understanding of the various use cases, what is going on, what is the amount of abuse happening on the blockchain, what is the illicit activity happening on blockchain, what is the impacts of sanctions, and all of that, as the only asset class in the world, you can measure with extremely high precision.
While that level of transparency is of course welcome, security is a whole other ballpark. The multi-year attack on Tokyo-based Bitcoin exchange Mt. Gox remains the biggest heist in crypto history. Similar attacks of varying scale have occurred throughout the decades since. The Chainalysis Crypto Crime Report for 2023 found that illicit crypto transaction volume hit a record high of $20 billion in 2022, despite the overall downturn in the market. And the prevalence of crypto crime has continued in 2023. Blockchain security firm Certic found that September was the worst month for crypto thefts this year, as hackers made off with $329.8 million worth of crypto. That included the $200 million hack on Hong Kong-based DeFi platform Mixin Network on September 23rd. Earlier in the month, a hacker took control of the X account belonging to Vitalik Buterin. The hacker encouraged Buterin's followers to connect their wallets to a bogus NFT project. They then drained out funds totaling almost $700,000. Elsewhere, the Lazarus Group, a hacker syndicate with ties to the North Korean government, continues to target cryptocurrency holders, reportedly as a means of securing funds for Pyongyang.
It's highlighted, I think, a lot more weaknesses in the business models that are going on for NFTs. It's also figured out a lot more highlights on things like wash trading. We like to think of wash trading as any trade that happens that wasn't intended to hold a position in that asset. It was more intended to be a wash, and that could happen for any number of reasons.
But illicit activity in the industry isn't just confined to wash traders focused on get-rich-quick schemes or hackers targeting individual investors and exchanges. The collapse of the Terra stablecoin platform last May kicked off the current crypto bear market. Terra founder, South Korean national Do Kwon, attracted international headlines as he went on the run in an attempt to avoid sanctions for his part in the platform's downfall. He is currently in jail in Montenegro after attempting to board a plane to Dubai using a forged passport. Coverage of Kwon's legal travails, pale in comparison to the media spotlight, shone on former crypto poster boy Sam Bankman-Fried. His crypto empire crumbled in dramatic fashion amid revelations in November 2022 that FTX had an $8 billion shortfall in customer funds. So, given the supposed transparency of blockchain and the analytics available, you could ask the question, why did no one realize what was going on sooner?
I don't think the industry wanted to listen, to be honest. I don't think any actually wanted to listen. They wanted to believe, and they wanted to believe that this is going to last a little bit longer. There might have been some signals, but it was really hard to show it to anyone. And the honest opinion is that a little bit more than a year ago, no one cared, because they kind of wanted to believe that this is where it is. This is going great.
The challenge then for the crypto industry in the wake of the FTX scandal is getting the public back on side despite a severely damaged image.
Nansen and other analytics providers can be very, very helpful to create more transparency for everyone. And this is frankly one of the main benefits of blockchains versus traditional finance, right? We can actually create transparency because natively the technology works in the way it does. So I think this is, it's super exciting for us to be able to help on that front.
One of the key tools in the locker for analytics firms is the emergence of artificial intelligence.
And I would say we've had two main revolutions in the field of AI. The first one was deep learning around 2013, and the second one now is with GPTs. And so there's a lot of stuff you can do now much more easily with GPT in particular, large language models and so on.
The other major challenge is maintaining the fine balance between transparency and privacy. Some of the decentralized finance platforms monitored by blockchain analytics firms aim for complete privacy.
You have to accept that you cannot have 100% transparency and 100% privacy at the same time. So it becomes a question of trade-offs, right? There are no perfect solutions, only trade-offs. There's a spectrum of how much tolerance we want to give to large transactions and so on, which becomes to some extent an ideological question and maybe even a political question. And it's something we have to figure out over the next few years.
Can blockchain analytics firms continue to tread that fine line between transparency and privacy? Can the incorporation of new technologies such as AI help identify and even prevent the next damaging collapse along the lines of FTX? If those efforts fail, will there be a market left to analyze? These are questions of existential importance for what is still a nascent crypto industry. For Forkast, I'm Will Fee.